Good afternoon, everybody. Luis here, wishing you a happy new week. And this is your weekly market update video to give you some insight on where the housing market is at and try to see where it's going. So let's talk about the debt ceiling crisis because that dog and pony show continues. So over the weekend, there were a lot of closed doors. See, I'm doing a lot of this closed door meetings, whatever that is supposed to mean, right? And the conclusion was that we were closer to coming to an agreement to raise that debt ceiling. But at the same time, there was the invoke the 14th Amendment buzz out there that simply means that the president can just raise the debt ceiling without Congress approval. But I know it will never happen, but I'm sharing this because I think it's just drama. It's just all drama, and it's creating volatility. And I'm going to say it really sucks. All right, because this makes it very challenging to predict where the interest rates are going. Speaking of interest rates, they are massively up. And I know I've been saying that the rates will drop once inflation drops, but there's another variable here, and that is the Federal Reserve funds rate. Since it was increased another 0.25% last month, regional banks are really feeling the pressure. This is probably going to cause more bank failures. You see, the customers right now are pulling their money out of these accounts. They're placing them with a bank that pays more interest, like a money market account. In order for this customer to get their money out, these banks they're with currently, they need to sell their collateral, which is in the form of a bond. And these bonds are selling for a lot less than what the banks bought them for. So they are taking losses every time a customer withdraws money. The more these bonds sell, the less they are worth, just like a stock. Last week, Charles Schwab just sold $2.5 billion in bonds, and they're taking losses with this. And this is causing other regional banks to sell at that lower price. And the more these banks are selling, the lower that 10-year is going. And this is causing the yield to go up, which causes the rates to go up. So a massive sale, which is indirectly caused by higher Fed funds rate that is squeezing banks to sell off. But how long will the Federal Reserve stay on this track? Inflation is down. So is the pivot finally here? Well, maybe. But first, we need to get past this debt ceiling dog and pony show, and then we can see what happens. But all the combination of all these things is causing a lot of volatility, and that's causing the rates to shoot up, which they're up a lot, and we'll look at it in a little bit. So moving on to economic calendar news, I'm not going to even cover anything because there's nothing. So let's take a look at the bond market to see what it's doing as a result of all this drama. All right, so last week, the 10-year yield was at 3.49%. And this week, it's up like over 20 basis points. What is that? 23 basis points at 3.72%. So that really caused rates to go up. So let's take a look at the rates as of today. So let's start with the VA. And again, this is a $500,000 purchase, owner occupied single family with a 740 FICO score. So we have the VA at 6.375%. That's up 0.25. No, I'm sorry, that's up 0.5. That's 0.5% up. So we were already getting closer to the 5.5%. Well, guess what? We're at 6.375. And FHA is up about 0.375, so about 0.375% up to 6.375. And then you have conventional, which is up about 0.5%, up 0.5%, up to 7.25. So rates are up. I know. I've been saying that the rates are ready to drop, but this debt ceiling drama, along with the bank failures, are keeping rates up. On the bright side, though, this should get other buyers that are not listening, are not in tune, back on the fence, which means less competition. They're going to be like, oh, I'm going to wait. And guess what? Less competition means lower prices as inventory rises. So remember, you're not buying a home because of the rates anyways. You're buying a home because it's the intelligent thing to do long term. And when I mean long term, I don't mean 30 years. I'm talking about 3, 4, 5 years. You can reap some massive benefits just in that short period. Some of those benefits are tax deductions from the IRS at the end of the year, the equity you build from paying down the principal on your loan, which means you're not throwing away your money. You're paying something down, something that belongs to you. And of course, market appreciation. I mean, everybody knows that one. So that's all I have for this week. Follow me on Instagram at @LuisRenteria_home loans for daily homebuyer tips and day-to-day updates. And as always, I appreciate you all and have a wonderful day.